Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's April 28th, 2013. Markets rose last week, regaining nearly all of the loss from the week before. It certainly wasn't due to the economic news, which was disappointing. New orders for durable goods were a big miss, and so is the GDP estimate for the first quarter, although expectations for it did come down after the durable goods report. But as I observed last week, it's still April, and the default trade ticket is still a buy. A big boost in sentiment came from a fresh batch of anemic economic news out of Europe, and yet another episode of the old bad news is good news trade. It's the usual premise that a weakening economy invites central bank action, and that will be good for stocks. There's been growing speculation the last couple of months that the European Central Bank might cut rates another notch. The bank's rates are already low, only 75 basis points, but that's about 75 basis points more than the Fed's rate. The lending gridlock in Europe isn't really a matter of interest rates, so a 25 basis point cut is unlikely to matter in that respect. However, it will help arrest the strength in the euro against other currencies, in particular the Japanese yen, which has been plunging against the euro in recent months. That drop hurts EU exports, and you will never guess who the largest exporter in the EU is. Or did you? That's right, it's Germany. Before the last couple of meetings, I thought that the bank might cut rates but probably wouldn't. In this case, I think that they probably will. Although the German central bank won't like it, they never like anything and would probably raise rates to 2 or 3% if they could, the German manufacturing industry will. Rather unusually, both the German central bank and Chancellor Angela Merkel were making comments about the ECB last week, which seems to imply that they both know that a rate cut is coming. Another notion for markets to cheer was that with the US data looking not so good, the Fed is more likely to keep its quantitative easing program intact through the end of the year. But all of that said, I don't think there's really a lot of conviction behind what is probably the last move up for some time. Traders know the market wants to get to 1600 on the S&P 500 index, and most are willing to go along, so long as the news doesn't get too bad. The week coming up is very busy with data, so it could be a struggle at times to keep everyone's eyes on the rate cut. And let's not forget the old end-of-month, first day of the month rally opportunity. It's not a certainty, but it works about 3/4 of the time. Finally, the jobs report on Friday should be a springtime inflection point for the market. But in which direction? Despite these historic levels, we are rapidly approaching the point where the market is far more likely to take a significant breather than not. We should get to new highs, but don't get dazzled by the stories because they're not going to last long this time around. I'm Kevin Flynn, and thanks for listening to Avalon's Market Minute.